Randy, is this a significant meeting? Is this anything more than a photo op?
I think primarily it will be a photo op. I mean, it shows the importance of the inflation issue. It shows the importance that the administration puts on it and is taking it seriously. But I don't think there's going to be any pressure put by the president or the administration on Jay Powell. I think they know the Fed's got to move, the Fed's moving, and I don't think they're going to try to stop that.
Hey, Randy, could the pressure come the other way? Is there a possibility that Fed Chair Jay Powell says, look, I can do all of this, but I can't help gasoline prices. That's something that you need to do. Could the pressure come that way?
Well, for sure. I mean, I think, I would assume the president and the administration know that, things like drilling, the Fed can't drill. Fed can't produce computer chips. They can do a lot related to interest rates and credit creation, but they can't do anything on the real side. That's really got to come from fiscal policy or come from regulatory policy.
Just out of interest, I'd like to get your take on this. Why do you think the president is writing an op-ed piece in the Wall Street Journal, which by definition is read by financial types, and meeting with Jay Powell, who probably isn't that recognizable to the average American? The average American is worried about gas prices and groceries. How does this meeting kind of jibe with the average American in terms of what is happening, in terms of what is actually happening in their own lives?
I think it's part of the president trying to show that he's aware that average Americans are facing challenges, and one of the things that he can do is try to make sure that the Federal Reserve is aware of that, and that he has shown that he is aware that the Federal Reserve is aware of that, and so he's trying to take steps to make sure that the administration is sensitive to and trying to move on taking down this kind of cost of living crisis.
Randy, if we take a look at the why, sort of why now? I understand that, the White House wants a pivot to the economy in June, et cetera. But in terms of the fall in the stock market, the tumultuous volatility that we've seen in the last 4 weeks, the rise in bond yields that we had seen earlier, the tightening in financial conditions. If there isn't a Fed put right now, do we feel like there's a Biden put somewhere?
That's a very interesting question. So that really comes on, as I said, really on the kind of fiscal side or on the regulatory side. And so I think there are certain things that the administration could be doing to try to relax some of the supply constraints. I don't think it involves more spending right now, but I do think there are things that they could be doing, and maybe this is a foundation for them to make some announcements down the line.
In terms of whether or not this is a Volcker moment, Randy, do you think we're getting to that point fairly soon? If the Fed doesn't deliver now, do we end up with a bigger problem down the road? And is that maybe the message that the president will deliver today to Jay Powell? You need to get on with this. You see what's happening around you. Don't make it a Volcker moment.
I completely agree, because I think if the Fed waits, the danger is that inflation expectations can become unanchored and get out of control. So far, they haven't. Inflation expectations certainly have moved up a lot for the short run, but in the intermediate to longer run, they're basically around the levels that they've been over the last decade, towards the upper end of those levels, but not really far from that. The Fed has the opportunity now. If they move quickly, if they move boldly, and they maintain their credibility, then people will say, okay, these people are serious. Maybe I don't have to continue to ask for 5, 6, 7, 8% wage increases. But if they aren't serious, they run the risk that it becomes unanchored, and then down the line, the Fed really has to raise rates a lot, and the economy will tank.
It does seem that from Fed speeches that it feels more like let's do a lot of 50s right now and then pause in September and then wait and see. And I'm just wondering how you would model what a soft landing looks like. So say we get 250 basis point increases. Does a pause count? What does a pause look like? What does a soft landing look like?
So, Jay Powell has, I think, introduced the term not just soft, but softish. So a new term that has come out there. Certainly, I think the economy is going to be slowing down. And I think that's not just because of the Fed. It's getting some pretty tough punches from the war, from sanctions. We just saw the agreement for the European Union on banning Russian oil, driving energy prices up. This is all really tough for the economy. So I think the economy will be slowing completely independently of the tightening of monetary policy. But now you've got this 1-2 punch, and so hopefully they will raise rates quickly enough that they don't have to raise them too high so that
Yeah.
investment can continue. But I think you've got a lot of these other shocks that are coming that are going to undoubtedly lead to an increase in unemployment rate and to a slowing of economic growth.
What is your assessment of the situation with the consumer right now? We saw consumer confidence a couple of hours ago coming out, still looks fairly elevated. Plenty of people are saying, and we hear it from the banks time and time again, that the consumer has plenty of money in their pocket. Is the consumer slowing down? And if the consumer is not slowing down at this point significantly, does that mean the Fed needs to go even harder?
So I think the consumer is slowing down a little bit. We've seen the savings rate come down quite a bit in the most recent data. So they're spending a lot relative to the current income. But as you were referring to, bank accounts seem to be fairly robust for a lot of people, which is good that they have that ability to spend. And I think people will continue to spend. But I think they're going to be a little bit more cautious going forward. I think some of the impact of sending out those checks over the last few years has been quite long-lived, but is going to be fading. So I think there will be some challenges for the consumer, especially if the unemployment rate starts to move up, as I think it might.
Yeah, let's get to the jobs number. And to your point, savings rate, 4.4%. We got that number on Friday. So clearly we're spending down our savings. We get the jobs number on Friday. What are going to be the key things that you're looking for? When you say the unemployment rate goes up, and that's part of what we want, right? If the Fed's going to put on the brakes, how high? What does that look like?
So hopefully it doesn't go too high, but you do have to remember that we are in the range, when we're under 4%, that's in the range of sort of the lowest levels over the last 50 years. We had that just before the pandemic, and we didn't have high inflation. So there's no necessary connection between high inflation and the unemployment rate below 4%. But given that inflation has gone up so much, I think it's going to be very difficult to bring demand down, to bring inflation down without it going up. Hopefully it doesn't have to go up that much, so a softish landing would get us certainly in the 4s and maybe even the 5s, but that is not devastating to the labor market as in some recessions that we've had in the past.
Brandy, in an ideal world, where would the Fed funds rate be right now?
Well, in an ideal world, the inflation rate wouldn't be nearly what it is now.
Okay.
The Fed and other central banks would have been able to start a little bit earlier.
But given where inflation is, where do you think rates should be right now?
So I think they've got to move them at least to the 2 to 3% range, so that markets and individuals see that they're serious about trying to slow inflation, and then we'll sort of see what other shocks are coming, whether inflation's starting to come down or not. I'm old enough to remember Volcker, and I'm old enough to remember that interest rates were in double-digit levels. There are many people that I say that to that just can't believe that can happen. It can happen. I don't think it will, and I don't think it has to. But I think that's the key reason why the Fed needs to move quickly.
Yeah, I remember when my parents' mortgage rate was like 15% or something for 30 years. That just seems crazy now.
And that was a good rate.
Right, and that was a good rate. Hey, Randy, before we let you go, tomorrow we see quantitative tightening actually start, very different than just stop actually buying bonds, for example. What do you think the effect is going to be? What are you looking at?
So I think the Fed is going to try to do this in a very gentle and very natural way. So rather than actually throwing securities onto the market, they're just saying, well, as our Treasury securities mature, as our mortgage-backed securities mature, we're just not going to continue to buy more new ones to keep the balance sheet where it was. Let it sort of slowly run off. So I think the markets are pretty well prepared for it. I think it's going to be a gentle beginning. At some point, they may decide to move it more quickly, but I think at first they're going to be fairly gentle about it. I don't think it's going to have any direct impact. If it, to some extent, markets already anticipated that. We've seen some volatility, but I don't think the actual slow beginning of runoff is going to cause volatility in of itself.